1. Start with energy. Explain with authority. Highlight with emphasis. End with warmth. The current trading price for Rivian Automotive Inc. sits at exactly $17.95 USD, showing a slight downward consolidation of minus 0.11, or a 0.61% decline, as of the market close on December 5th. In the after-hour session, the stock has remained relatively flat, drifting down another 2 cents to $17.93 USD. When you see a stock trading just under the $18 mark after the volatility we have witnessed in the electric vehicle sector, it is easy to dismiss this 0.61% drop as just another red day in a bear market. That is the expectation. The general consensus, fueled by headline-reading analysts and skeptical voices on social media, is that the EV hype is dead, that high interest rates have crushed the capital-intensive auto startups, and that Rivian is slowly bleeding out alongside its peers. The reality, however, is that this specific price level of $17.95 USD represents a massive psychological and technical victory. It signifies that the market is finally beginning to price Rivian not as a risky startup on the brink of collapse, but as a maturing industrial titan that has successfully secured its survival through strategic partnerships and brutal cost-cutting. The reality is that while the stock is red today, the underlying thesis has never been greener, primarily because the bankruptcy risk that haunted this ticker for the last 2 years has been effectively removed by the massive Volkswagen joint venture. You are looking at a company that has transitioned from survival mode to execution mode, and the market is quietly accumulating shares while the retail crowd looks the other way. To truly understand the weight of this moment, we have to dissect the tension between the cash burn narrative and the industrial reality. For years, the expectation for Rivian was that it would simply run out of money. Building cars is arguably the hardest business on earth. You need billions of dollars in upfront capital before you sell a single unit. The bears looked at Rivian's balance sheet, looked at the cash burn, and predicted a death spiral. That was the expectation. The reality is that Rivian pulled off a masterstroke with the Volkswagen deal, securing up to $5 billion in capital and, more importantly, validating their software stack. When the second-largest automaker in the world, Volkswagen, looks at your technology and says, "We need this for our cars," it ends the debate about whether your product is legitimate. This $17.95 USD price reflects a repricing of that risk. The bankruptcy discount is being removed, and now we are left with the raw valuation of the business. Let's dive into the intraday mechanics and what the 0.61% drop actually tells us. In a high beta stock like Rivian, a movement of less than 1% is essentially flat. It indicates a balance of power. The sellers are exhausted. The people who wanted to panic sell because of EV winter headlines have already left the building. Who is left? The long-term holders and the institutional accumulators. If you track the order flow on your Interactive Brokers trading terminal, you will likely see that the volume on down days is drying up while volume on up days is increasing. This is classic accumulation behavior. Funds are stepping in to buy the dips, knowing that the R2 platform is on the horizon. For the individual investor using Schwab Intelligent Portfolios or managing a Fidelity brokerage account, this stability is the signal you have been waiting for. It suggests that the floor is in and the stock is building a base for its next leg up. We must address the R2 factor because it is the engine of the future valuation. The expectation is that the R2 is just another electric SUV. The reality is that the R2 is Rivian's Model 3 moment. The R1T and R1S are incredible vehicles, arguably the best consumer trucks on the planet, but they are expensive. They are six-figure status symbols. The R2 is the mass-market volume seller. By pulling forward production to the Normal, Illinois plant instead of waiting for the Georgia facility, management showed incredible agility. They saved over $2 billion in capital expenditures and sped up the timeline. The market initially reacted with confusion, but the reality is that this move de-risked the entire company. It means they don't have to build a massive new factory just to start selling their most important product. This kind of operational discipline is rare in founder-led companies, and it is a key reason why the stock is holding steady at $17.95 instead of drifting back to single digits. When you compare Rivian to the broader market, specifically to Tesla stock, you see a divergence in maturity. Tesla is a teenager, it has mood swings, but it has a job and pays rent. Rivian is the precocious child that just graduated early. Investors often look for investment help or browse investing sites looking for the next Tesla. The mistake they make is assuming the path will look exactly the same. Tesla had to invent the market. Rivian just has to capture it. The demand for electric trucks and SUVs is already proven. The challenge is purely execution and margin. This brings us to the gross margin positive milestone. The expectation was that Rivian would continue to lose money on every vehicle for years. The reality is that they have aggressively renegotiated supplier contracts, redesigned the vehicle architecture, the Peregrine project, and improved line efficiency to the point where they are crossing into positive gross profit territory. This is the holy grail. Once you cover your variable costs, every additional car you sell contributes to paying off the fixed costs. The moment a manufacturer crosses this line, the stock usually re-rates significantly because the path to net profitability becomes a math problem rather than a hope and a dream. Let's talk about the specific competitive advantage that the market ignores: the brand. In a world of generic crossovers, Rivian has built a lifestyle brand that rivals Patagonia or North Face. People don't just drive Rivians, they identify with them. This cult of ownership is a powerful moat. If you go to a Rivian meetup or scroll through forums where owners discuss their vehicles, the enthusiasm is palpable. It is very similar to the early days of Apple stock or Tesla stock. This brand equity allows them to maintain pricing power even when competitors are slashing prices. While Ford and GM are struggling to sell their EVs and delaying production, Rivian is seeing consistent demand. The reality is that legacy auto is finding it much harder to pivot to software-defined vehicles than anyone expected. Their software is clunky, their apps are slow, and their user interface feels dated. Rivian, built from the ground up as a software company that makes cars, offers a user experience that is light years ahead. This software advantage is what Volkswagen paid for, and it is what will keep customers loyal. I want to pause here and ask you a direct question about your own portfolio strategy. With the EV sector being so volatile, are you playing this for a quick trade or are you holding for the 2030 vision? Comment below how many shares of Rivian you currently hold and whether you think the R2 will be the catalyst that pushes this back to all-time highs. It is always interesting to see if the community is looking at the technicals or the long-term fundamentals. Now let's look at the institutional landscape. If you are using a Fidelity mobile app or checking your SoFi Active Investing account, you might notice that news about institutional ownership often lags. However, the recent 13F filings have shown some interesting trends. We are seeing a rotation. The tourist capital, the funds that bought it just because it was an IPO, has largely washed out. Replacing them are the deep value funds and the growth at a reasonable price GARP managers. These are the investors who look at the $7 billion in cash on the balance sheet, the $5 billion from Volkswagen, and the tangible assets and realize that the enterprise value is attractive. They are not buying for a squeeze, they are buying for the decade. This institutional base provides a floor under the price. It makes it much harder for shorts to drive the price down because these new owners are not selling on a bad headline. They are holding for the fundamental turnaround. We also need to discuss the Amazon relationship. The expectation was that Amazon was the only thing keeping Rivian alive. The reality is that Rivian has successfully negotiated the end of the exclusivity clause with Amazon. This is huge. It means Rivian is now free to sell its electric commercial van to anyone. Think about the fleets out there. FedEx, UPS, DHL, massive plumbing and HVAC companies. They all have sustainability mandates. They all need electric vans. Until recently, Rivian could only sell to Amazon. Now, the entire global logistics market is open to them. This opens up a revenue stream that is less sexy than the consumer trucks, but potentially more stable and lucrative. Fleet managers buy on total cost of ownership, and electric vans are cheaper to run than diesel ones. If Rivian announces a major deal with a logistics giant like DHL or FedEx, the stock at $17.95 will look incredibly cheap in hindsight. Macroeconomics plays a massive role here as well. The interest rate environment has been the biggest headwind for Rivian. High rates make car loans expensive, which hurts demand. They also make Rivian's debt more expensive to service. However, the expectation is